Okay, in the first video we talked about, ended up talking about journal entries. Again, 6 items for a simple journal entry: a date, a debit account, a credit account, a debit amount, a credit amount, and a description. We also skip a line between each one of these. Never have them close together, just always skip a line. And so somebody scanning a page of these can see these at a glance. They can see the accounts that were debited, the accounts that were credited, how much, the description, and then the blank line tells them this is a new one. By the way, any account that's going to be debited will come first. If there were 2 accounts being debited, let's say that the owner invested cash and equipment in the company, then you would debit cash for that amount, you would debit equipment for that amount, and you would credit common stock for the total. Let's say it's $15,000 of cash and $15,000 of equipment. You would debit cash for $15,000. You would debit equipment for $15,000, and you would credit common stock for $30,000, so that the credits and the debits equal, and all the debited accounts go first. Okay. Once you do this, if you can imagine a page of these or several pages of these, you can see all the transactions, but you don't have them summarized. All you have is the data has been captured. You haven't really got it in any form that you can use it. So what we do is we set up individual accounts for cash, supplies, equipment, common stock, prepaid insurance, all those things, accounts payable, so that we can summarize these transactions in each account. I'm going to show you a ledger. This is the cash account in the general ledger. It has the number over here, account number 101. Remember I told you in the earlier video that the numbering system, assets always start with a 1, liabilities always start with a 2. Equity accounts, common stock, retained earnings, dividends, those always start with a 3. Revenues always start with a 4, and expenses can be anything above a 4, 5, 6, 7. Okay, you start with a date. You don't have to put an explanation most of the time. If it's an adjusting entry or a closing entry, which we'll get to later, then you would, or if it's correcting an error. But unless it's something different than a regular transaction, most people don't put an explanation there. It's in the journal. The posting reference column we're going to leave alone for just a second. So this was the first entry we had. We had a debit to cash, and you'll see up here, there it was. The cash was debited. When we posted in the general ledger, there it is, the debit. The balance in cash is $30,000. Now, this is called a 3-column ledger. It only has 1 column for the balance. And so you know, since it's cash, that balance is a debit balance. You just know that. You don't have to be told that. The second entry was a credit to cash. So you can see here the credit to cash being posted on the 2nd. And the balance now is $27,500. You had a $30,000 debit entry and a $2,500 credit entry, reducing cash to $27,500. In the next entry, which we don't have illustrated up here, we purchased $26,000 worth of equipment, I think, and so we credited cash for $26,000 down to the balance is now down to $1,500. The other side of this you don't see. We've also posted $30,000 as a credit to common stock for this entry. We've posted $2,500 as a debit in the supplies account, and then $26,000 as a debit in the equipment account. So all those are happening at the same time. The posting reference column in the ledger, you need to write this down. The posting reference column in the ledger refers to the page of the general journal or to the page of the special journal, like the payroll journal, the accounts receivable journal, the cash receipts journal, cash payments journal, the special journals. The page of the general journal, or the page of the special journal that it comes from. So this is general journal page 1, and this is general journal page 1, and we would put here under the cash where this is the posting reference in the journal, we would post the account number. When we've posted it, when we've recorded all this down here, we would put the page of the general journal down here. Then we'd go back here and we'd jot down 101 to let, and that just tells somebody looking at this that this line has been posted. And then we'll go and we'll post the common stock one. And when we get that into the, I think, 300 or 301 account, whichever one it is, as a credit to common stock, then we would come up here and we would put that account number there. The same thing with supplies. We would, when we enter this $2,500 as a debit to the supplies account, in the supplies account, we'd put G1 again because that's the page it comes from. And in the general journal, we would post the account number. Now this is what a ledger looks like. The T account approximates this. It just gives you the debits and the credits, but doesn't give you the balance. And so you have to come up with a balance at any given time. And the way you do that is add up the debits, add up the credits, and subtract them. The side that has the most money on it is the side that has the balance. So this has $34,200 on the debit side, and it has $28,500 on the credit side. So there's more money on the debit or left side here, and that would be the balance. The balance would be the difference between those two. And that balance is $5,700. We'd have to figure it out in a T account, but on the ledger, there it is. We don't have to know a whole lot more about that. We can do it. So here's the process. Let's look at their process for entering these journal entries to the accounts. The step 4 of processing transaction, it says, is to post the entries to the ledger, which we just talked about up here. It gives us 4 parts. A, identify the ledger accounts that are debited in the entry, account that is, or accounts that are. So in the entry in this first one, we identify the debit accounts as cash. And we come down here and post this. Here's the way we do it. After we identify the accounts that are going to be debited in the ledger, we enter the debit amount in the ledger, just in the debit side of the ledger. And in the PR, the posting reference column, we place the page and the ledger the page in the journal that it comes from. G is the general journal and page 1. In the ledger, we enter let me go back here. In the journal, we go back up there and we enter the account number in the posting reference column. So we'd enter 101 here because that's the account number for the cash account. We'd enter 101 here. So this will reference the account in the ledger. The ledger will reference the account, the page number in the journal, and the date. So with the page number, the date, we can find the entry quickly. And then you just repeat the process again. Part C is basically recognize or identify the ledger accounts that were credited and then post to those accounts, entering the page of the journal where it comes from in the ledger, and in the journal going back and entering the account number. So here we have a picture of it. This account, we have $30,000 on the first being debited to cash. So I go to the cash account, debit for $30,000. I got the date. The balance now is $30,000. I put the page of the journal where it came from, and I put the account number up in the ledger. The second thing, we find the credited accounts. We notice it's common stock, so we find that in the ledger. It's a credit of $30,000. We're going to put it in the credit balance, credit entry, credit transaction column, and enter it in the balance. Now this is a debit balance. And this is a credit balance. I know this because I know that cash has a debit balance and it's an asset. Common stock has a credit balance. I know this. You have to know this too. So here is this one journal entry posted in 2 different places. But as I post these, now I have a summary of what's going on, and it gives me the balance in that account at any given time. This is not a bad chart to copy and paste somewhere. here's the different processes, the different steps to get everything posted in the ledger. I'm going to go through a few of these, and then we're going to identify the accounts. Fast forward receives $30,000 cash from Taylor in exchange for common stock. So none of the accounts are cash and common stock. Cash is an asset, debit balance. Common stock is an equity account, credit balance. I'm going to enter it in the journal. The date would be December the 1st. Debit cash, credit common stock. Debit cash for $30,000, credit common stock for $30,000. And then when I get ready to post it, and I don't have to post it that minute, but when I do get ready to post it, that's when I'm going to fill in the posting reference column, and never fill it in until you post it. So I find the cash account. You notice this is a T account. It doesn't look like the ledger up there. This is just a T account. So 101 is a number. I'm going to post a debit transaction of $30,000, which comes straight from the journal. And there's no way to do this easily in here, but in the general ledger, I would put G1 for my reference. You really can't do that well here. And then I'd put the account number in the journal, 101. Common stock is going to be $330,000 to the account number 307, so it's a credit to 307 over here. And again, the account number here. You notice they have 1 and 1 here, and that's the way we organize this in this chapter or in this book is entry number 1. This is the first entry. See number 1 here. There it is. We paid $2,500 for supplies. We paid the cash, so the entry is going to involve cash as a credit because cash is being used up. Supplies are being increased, so debit to supplies or credit to cash. Again, all the debited accounts come first, credited accounts come second. This is not going to be filled in until I post, but when I post it, I'm going to carry this $2,500 debit to the supplies account and post it there. I'm going to carry this $2,500 credit to the cash account and post it here. No balance visible, but I can figure it out pretty quickly. 30,000 minus 2,500 is 27,500. I personally, when I'm posting, I really would like to do it in a ledger, but the T accounts this book uses quite a bit. All right, we pay $26,000 cash for equipment. Cash is going down, that's a credit. Equipment is an asset, so going up, that's a debit. Debit equipment, again, debits come first. This is entry number 3. Debit of $26,000. Cash is a credit of $26,000. I post the debit to the equipment account, reference number 3, and then the account number in the journal. I post the $26,000 credit to cash as a credit in the T account to cash. Reference it to the third transaction, and reference over here in the journal to the account number. The number of the account. I purchased supplies on credit. Okay, since I purchased on credit, that's going to be accounts payable and supplies. Supplies is an asset. I purchased them. It's going up. That's a debit because it's an asset. Assets are increased by debits, have a debit balance. Debit supplies and entry number 4 for $7,100. Credit accounts payable. Accounts payable is a liability going up with a credit for $7,100. So $7,100 debit to supplies, and there it is. A credit of $7,100 to accounts payable over here. Opposite sides of the equation. As supplies went up on the debit side, accounts payable went up on the right side. Supplies are assets, accounts payable is liability. And then the posting reference column in the journal is going to have the account numbers. We provide consulting services and collect cash. Cash goes up, we collected it. So cash is an asset, increased by debits with a debit balance. I'm going to debit cash. Consulting revenue is an equity account with a credit balance. So cash is going to be debited, $4,200. There it is, entry number 5. You can see the entries now in cash. This gets more and more complicated to figure out the balance at any given time. That's why the preferred way is the general ledger, actually the ledger cards, but T accounts are going to be something you're going to see a lot of. $4,200 debit to cash and a $4,200 debit to consulting revenue, all referenced with the transaction number in the in the journal, it would be a date otherwise. And excuse me, the account number is listed in the journal. The account number from the ledger is listed in the journal to reference that. Let's do, I want to do one more here if I can find it. Here we go. We provided services of $1,600 and rented part of its test facilities to a customer for a total of $1,900 on credit. The reason we know it's on credit because he was billed for it. It didn't say we collected it. It was billed for. That means we sent him a bill. He's going to pay it later. That would be accounts receivable. Accounts receivable is an asset with a debit balance. You see it on the left side of the equation over here. Consulting revenue and rental revenue are both equity accounts with credit balances, or the right side, since they're on the right side of the equation. So I'm going to debit accounts receivable first, $1,900, and credit the individual revenue accounts, $1,600 for consulting revenue and $300 for rental revenue. Post them to the ledger. Here's my reference. This is not a date now. This is just a number we're using to keep up with it. But in the real world, it would be dates. $1,900 debit to accounts receivable. In the journal, go back and put the account number. $1,600 a credit to consulting revenue. Again, reference number 8. And then the account number back in the journal, and $300 posted rental revenue. Again, referenced transaction number 8, and the account number is pulled back over to the journal. Now, in this case, when we get to the end of this, you can take all of our accounts and add them up and come up with a trial balance. And we'll take care of that in another little video. But I want you to look at this. This is the cash account. When we get done, you could add up all of these guys and all the credit entries and all the debit entries in cash and come up with a balance. Now, if this account had a balance at the beginning, let's say it had a $10,000 balance, well, that would be up here. You would put B balance, or BAL, in the debit column and put that $10,000 up here. And then you would include it as you add everything together, the beginning balance plus any transactions, and then less any credit transactions to come up with a new balance. I want to go through this one too. This is prepaid insurance. We bought an insurance policy. That insurance policy is for 24 months. Well, I'm not going to use 24 months worth of insurance today. I have to use it over 24 months. So what I'm going to do is I'm going to create a prepaid expense, prepaid asset called prepaid insurance. It's going to be an asset account that I'm going to reduce over the next 24 months. So every month I would move $100 of this to an expense account, but we'll deal with that in Chapter 3. Anyway, a debit of $2,400 to prepaid insurance and a credit of $2,400 to cash. Here we go. Entry number 13. Debit prepaid insurance, increasing that asset by $2,400. There we go. And the account number over in the journal. Crediting cash, you know that it's indented and it's in the credit side. So we're going to credit cash for $2,400 and record the transaction number in the ledger, the T account, and the account number over here in the journal. Skipped ahead a little bit, but this is a picture of all the T accounts that we've done. Here's all the different transactions in the cash account. You see we've added up the assets, the debit side of the asset, and added up the credit side of the assets. Whichever one has the most money in it, we're going to subtract the other from it and put the balance on that side. So we had 3,000, 33,000, 37,200, 38,200, 40,700, something like that. I don't know. I should be thinking about it before I start talking. But we have more money on the left side, the debit side, than you do on the right side, the credit side. So the balance is on the right. And we do that for all of these. This is easy. Accounts receivable was collected. There's no balance there. Even though it's no balance, we still stick it over here on the left side where it belongs. These are all left-sided balances, debit balances, because they're all assets. These are all right-sided because they're liabilities. Common stock, you notice credit balance, consulting revenue credit balance, rental revenue a credit balance, dividends a debit balance, expenses debit balances over here. Make sure you know how to get a balance from a T account. And I want to do one more thing real quickly. I think it's going to be down here. Really good problem to play with right there. And here's the trial balance. We take the balances from each one of those accounts that we just did and just list them in order, in numerical order. Cash starts with 101, and you get down to accounts payable, and it's 20 something or other. Consulting unearned consulting revenue is also a 2. Remember, unearned revenue is a liability. Common stock will be a 300, dividends a 300. Consulting revenue will be 400s, and expenses will be 500. Anything above 4. Add them all up. Add up the debits. Add up the debits. Add up the credits, and they should equal. If they don't equal, you need to go back and find your error. You've made a mistake somewhere. And that's how you prepare a trial balance. This is an unadjusted trial balance. And we'll tell you what that means in another chapter.